Hello, my name is Nick Griffin. I'm the CIO of Munro Partners, and in this short video, we're going to run through our ongoing investment thesis around infrastructure as service within the cloud computing market. We're going to identify some of the key winners and explore what's actually been holding them back in the last 12 months versus, say, the last 3 years. And so what are we actually talking about when we talk about cloud computing? And what is infrastructure as a service? Well, here on this slide, we're showing you worldwide IT spending by subsector. It's a $2.1 trillion per annum industry, split by software, devices, IT services, and data center. However, as many of you will know by now, as you migrate to the cloud, like say with a Microsoft 365 subscription, your data, updates, and security are all now controlled by the cloud. And so what we see today is now more the picture on the right, whereby the cloud ecosystem is taking a bigger and bigger share of what is total IT spend, and the lines between these subsectors gets blurred between the one-stop shop of the cloud. So if we focus now down on just that public cloud piece, you can see that this is now a $200 billion per annum business and growing rapidly. Almost all the companies we meet are migrating to the cloud via the big vendors such as Google, Microsoft, and Amazon, and in the developed world, Alibaba. And these companies literally provide scalable, commoditized compute power via their network of data centers to software companies and corporates all over the world. Their scale allows the cost to go down, and hence that accelerates the desire for people to transition to the cloud. And to do this reliably and dependably, you need to be really, really big. And hence that's why there are so few of them. Now on this next slide, I'm showing you the performance of these companies over the last 3 years. Now we've actually owned Microsoft, Google, and Amazon since the first day of the fund, and we've owned them for many years prior to that at our previous firm. And for all three, we've enjoyed strong, absolute, and relative returns as this thesis has played out, while Alibaba is more of a recent addition. But 2 out of the 3 names are up over 100% in just over 3 years. However, despite this strong performance, our domination thesis has taken a pause this year. Despite being great contributors over the last 3 years, only one of these companies, Microsoft, has contributed in the last 12 months, while the rest have either been flat or detracted value over the last year. Have we missed something? Earnings are still growing, but their multiples are contracting. We see a number of potential reasons why. The first is obviously regulatory uncertainty. These companies have dominant positions in a number of businesses that allow them to become dominant, and this is manifesting itself in concerns about data protection or anti-competitive practices. Microsoft is the cleanest, so to speak, and hence has managed to press on. The trade war has also had its fair share of influence over Alibaba, as have recent defensive rotations, or merely the fact that these companies went up in the last 2 previous years and stocks don't go up in straight lines. Looking at the valuation of the companies, we see a lot of these concerns as adequately priced in. While generally perceived as high multiple stocks, here we can show you that on an EV to EBITDA basis, they are in fact cheaper than most consumer staples. This is despite 3 to 4 times the expected growth over the next 3 years, with dominant competitive positions. And while it's often difficult to forecast the economy, interest rates, political market movements, etc., forecasting what's going to happen here is actually relatively easy. Assuming lower costs drive the continued migration of workloads to the cloud computing over the next 5 years, and assuming no significant new entrants, then the Big Four should enjoy more than doubling of their cloud infrastructure revenues. We would also expect many of them to improve margins significantly as they enjoy the benefits of scale, which will ultimately contribute to sustained earnings growth in the years ahead. And while we recognise the concerns in the overall market, the maths tells us otherwise. Rather than rotating from growth to value, or high to low multiple stocks, or even from non-dividend to dividend payers, we're choosing actually just to stay the course with these few big winners. This simply looks like a disconnect between the equity market time horizon and what's happening in the real world. The maths tells us quite clearly that we can reasonably expect them to be a lot bigger in the future, and we look forward to a resumption in their performance in the months and years ahead. Thanks very much for watching.